If you're a high income earner and you feel you pay way too much in taxes, did you know that there's a way that you can retire in the 0% tax bracket? Now, I know what you're thinking. This lady is crazy. I make way too much money to qualify to open a Roth IRA, and my company doesn't offer me a Roth 401k. So what can my options possibly be? But wait, hold on a second. Stick with me. If you stick with me till the end, I will show you what the wealthy elite are doing to build their portfolios all tax-free. My name is Amanda Riva. I have been a licensed financial coach and consultant for the past 8 years as of the date this video was produced, and it is my goal to illuminate to the world what wealthy people know and understand about money. And one thing all wealthy people understand is how to make more money and how to pay less taxes. So let's dive in. Now, you are correct. If you're a single individual making over $240,000 a year on a W-2 paycheck, you make too much money to qualify to open up a Roth IRA. Now, one thing you can do is play the Backdoor Roth IRA game, which means that you contribute into a traditional IRA and then you later convert that into a Roth IRA where you will pay the taxes in the year that you do the conversion. Now, the downside to that is you still can only contribute up to $7,000 a year if you're under the age of 50 and up to $8,000 a year if you're over the age of 50. And realistically, what is $7,000 or $8,000 a year going to do for somebody that is considered a high income earner? Not very much. And if you don't get offered a Roth 401k through work, your tax-free options might seem bleak. But what if I told you that there was an account that existed where you could design it yourself for you to be able to contribute as much money as you want per year into it, and that money would grow and compound all tax deferred, so that way when you go to access it in the future, you can access it all tax free. And the best part is, the more you make, the more money you can save. Well, it exists. It's called an IUL, or what Forbes likes to call it, the rich person's Roth. Okay, so what is an IUL? Well, IUL stands for Index Universal Life, where at its core, it's basically just a permanent life insurance policy that has this cash value component that is connected to it, that is tied to a stock market index of your choosing, like the NASDAQ or the S&P 500, for example. Now, this cash value component will grow by you overfunding the cost to own the policy. All those dollars that you overfund the policy by pour into your cash value bucket, and they will grow and compound all tax deferred, tracking a stock market index of your choosing. So they are indexed to the market, meaning when the market goes up, that account value is going to grow. But when the market goes down, the insurance company assumes all the risk and you don't take any losses to your portfolio. Now, they do this through spreads, caps, or maybe fees on the growth. The way I explain it is you give up a little bit of the growth so you don't deal with any of the downside risk. But this does give you the feel of investing without having to worry about losing all of your money. And the best part is you control the cap in an IUL. Unlike a 401k or an IRA, the government controls the cap on how much you can contribute per year. With your IUL, you control the cap. So the more life insurance you get, the more money you can put into the policy. The less life insurance you get, the less money you can put into the policy. So if you want to save $50,000 a year, $100,000 a year or more into your IUL, you can do it. You just have to get a big enough death benefit to allow that amount of money to be contributed per year into the policy. Now, don't believe me that somebody would actually save $100,000 a year into a permanent life insurance policy? Check this out. Let's take a look at some of what General Electric's top key executives are doing with their money. This document is called a proxy statement. Every public company has one. You can Google these. This is looking at GE's from 2019, so it's a little bit old, but it gives a really good table on what these guys are doing with their money. So if we take a look here, you're going to see the top 6 key executives with General Electric. You've got the CEO, the SVP and CFO, former chairman and CEO, SVP, VC, and CEO, and then SVP and CEO of healthcare. You'll notice that it goes back 3 years, what their salary was, what their bonus income was, what their RSUs were, and of course their stock options. Now, you'll notice they take a good chunk of their income in RSUs because that allows them to defer the taxes. They don't have to pay W-2 ordinary income taxes on this money if they defer it into stock. And they take a measly salary of roughly about, on average, I would say just over $1 million per key executive. Larry took a much lower salary here because he took a much higher amount getting deposited into his RSUs. Now let's see what they're doing with this money. If we look here, you'll see all 6 of the key executives and exactly where all of that money is going. And you'll notice the very first section that you see is life insurance premiums. Take a look at this. Culp does not have anything, but Miller has $46,000 a year going into life insurance. Flannery has $126,000 a year going into life insurance. Holston, nothing. Joyce, $125,000 a year going into life insurance. And Murphy, $35,000 a year going into life insurance premiums, while the majority of them have just $9,665 going into their traditional retirement account, which is most likely a 401k with General Electric. But why? If we zoom in here and take a look, life insurance premiums, taxable payments, so this money's already been taxed, it's after-tax dollars going in, taxable payments to cover premiums for universal life insurance policies they own. These policies include 1, executive life, which provides universal life insurance policies for the indicated named executives totaling $3 million in coverage at the time of enrollment and increase 4% annually thereafter. And 2, leadership life, which provides universal life insurance policies for the indicated named executives with coverage of 2 times their annual pay, salary plus most recent bonus. The reason the other 2 key executives do not have it is because as of January 2018, these plans were closed to new employees and employees who were not already employed at the relevant band level. So if these key executives that are all making over an average of $1 million a year and saving roughly about $100,000 a year into these permanent life insurance policies, if it's good enough for them, wouldn't you agree that it's also good enough for you? Now, of course, you don't have to save $100,000 a year into these accounts. It's just showing you what other people are doing with their money. Now, there is one catch to it. Because of the fact that these are life insurance policies, you do need to get approved before you can just go out and own an IUL policy. So the insurance companies will look into your age, your health history, and your background. And assuming that you don't have a bunch of felonies or anything crazy in your medical history, you have a high chance of most likely getting approved to own one of these policies. So let's actually dive in and take a look at a real live example of a healthy male that is 40 years old. We'll say he's making roughly $300,000 a year and he is a healthy non-smoker, wanting to save at least $50,000 of after-tax dollars into his IUL. Let's see what it would look like. Okay, here we go. So here you're gonna notice in the top right corner, you're gonna see that this individual is saving $50,000 a year into their IUL policy. In order to do that, and in order for that to be the maximum that they can contribute into their plan, which is the goal if you're trying to really get this account to grow and earn you cash value quickly, he would have to get a minimum death benefit of at least $927,489. Now, I would probably not sell that to him. I would most likely round that up to $950,000, maybe $1 million. You do get a discount with most insurance companies every time you reach $250,000 in insurance, so the cost actually goes down. This is just for example purposes. So this is the minimum death benefit that would be required for him to save $50,000 a year. So if we look over here to the left, you're going to see the year is how many years the account has been opened. The age is how old this individual is and counting. Assumed premium outlay. This is this individual saving $50,000 a year. Now this could be once a year he's putting in $50,000. This could be broken up into monthly installments. This could be broken up into small monthly installments with lump sums added throughout the year. There's a lot of ways that they could make this contribution into this policy. Then we are going to take a look at the interest and how this grows. So this middle section is showing if he wasn't growing in the index strategy, if he was just earning a flat 3.5% fixed interest every single year. Most of my clients don't choose that option because they want the chance to earn really high interest. So we can disregard the center section and we're gonna look at the one all the way over here to the right-hand side. So if we zoom in on that, you will see this is the non-guaranteed values where we are looking at an average rate of return, if we zoom down here, of 6.11% per year getting earned. Now we'll say the actual average rate of return on most of these IULs is significantly higher than that. We are just not allowed to show it. Insurance companies are required by law to follow federal guidelines and what they show in these illustrations, and most insurance companies are not allowed to show over 6.5% or 7%, even though they all average way higher than that in reality. So, but this should give us an idea of worst case scenario. So if you look here, net accumulation, this is the cash value growing behind the life insurance. So it's the premium paid into the policy, the $50,000, minus the cost to own the $920-something thousand death benefit, plus any interest that's earned. The surrender value is how much of the accumulated value this individual is allowed to touch. So if he put in $50,000, there's an accumulated value of approximately $46,000. He could access about $26,000 out in the form of a loan or withdrawal after that first year. Now, he's probably not going to do that, but he does have access to this money. Some insurance companies within just a couple weeks of putting the money in. Some insurance companies make you wait 1 year, 2 year, 3 years. It just depends on the company you choose. And then the death benefit is going to be that $920-something thousand plus the value of the policy. So if he were to pass away, his family would inherit the net accumulated value plus the death benefit, all tax-free, which is why this number is increasing over here on the right-hand side. So if we go back to the left and let's say we scroll ahead maybe 10 years, and if this individual does this for 10 years, he would have contributed $500,000 by the time he's 50, and he would have an account value of approximately $619,000 inside the account, and he can access approximately $610,000 of it tax-free on the form of different policy loans. Now, let's say he doesn't touch it, right? Let's say he's going to continue to save. Let's just assume that this guy wants to retire at age 60, which is actually way younger than the average age for retirement today. But if he does, right, he would have saved into the policy about $1 million of after-tax dollars going in. And if we look over here to the right-hand side, he's estimated to have an account value of about $1.8 million sitting in there, accessible to him all tax-free if he accesses this money in the form of different policy loans that are available. Loans just allow you to access the interest tax-free. Don't get afraid when you hear the term loan. It doesn't mean that you owe the money back. The loan is the key feature inside of an IUL that allows you to access your interest tax-free. If you withdraw your interest, it will be taxable, but if you loan it to yourself, it's tax-free. And some of the loan options are completely free. They don't even charge you interest to do it. But let's take a look and see what this will look like for him in retirement. Okay, so in retirement, let's zoom in and let's assume that now from age 61 to maybe age 90, which is when this individual thinks he might pass away, he's no longer contributing money into the policy. You'll see a 0 under premium outlay. He's going to start taking distributions, income to live off of in retirement. And we're being very conservative here, but we're estimating that he'd be able to take out approximately I'm just going to say $150,000 a year because it's $149,954 every single year, tax-free, because he's doing it on a loan from his IUL as an income source in retirement, as supplemental income to him. If he does that, let's just say for 30 years, by the time he's 90, again, he would have contributed $1 million of after-tax money going in. He would have withdrawn just about $4.5 million tax-free from his IUL because he took it in the form of a loan. So if you gave me $1 million and in return I give you back $4.5 million and it was tax-free, would you take that deal? I'm sure most of us would. There you have it. This is one great way high income earners can start to shove as much money as they want with no limit, no restriction into a high yielding, high compounding vehicle that will grow and build wealth for them, all tax deferred so that they can access it in the future, all tax free. I have always loved IUL policies ever since I found out about them 8 years ago. The key is, one, we have to be able to get a proof of them. So it's based on your age, your health history, and your background. That's going to determine the cost of the policy and ultimately determine whether or not this makes sense for you. And the second component is if your goal is to use this for cash value, as we mentioned earlier, you got to watch the size of that death benefit. The lower the death benefit, which is the life insurance, the faster your money will grow because the cost of the policy is lower. But that death benefit also controls how much you can contribute into the account. So you want to be thinking, what's the most that I could see myself contributing over the next 3 to 5 years, and get a death benefit that's low enough to allow that amount of money to go in per year to happen. So hopefully you learned something today. Hoping this opened your eyes up to the fact that just because you make a lot of money now and you pay a lot of taxes now doesn't mean that you can't retire in the 0% tax bracket. And I want to challenge you to think about what it would feel like to be receiving your paycheck every single month and no taxes were taken out. You have the ability to design that lifestyle for yourself through accounts such as IUL policies. So again, this is one terrific strategy, in my opinion, that a lot of people can benefit from. The key is that you do not take this video as investment advice. I highly recommend that you consult with a licensed life and health agent in your resident state or country to help navigate you through designing one of these policies for yourself, because they can be a little bit complex. If you live in the United States and you'd like to work with me or my team, we would love to meet you. You're welcome to click the link in my bio. That will take you directly to my calendar where you can schedule a call with me to go over your options, and it's all complimentary. So again, I have been working in the industry for 8.5 years. I find so much value in these accounts and this education and information. So I hope that you take this and you share this video with somebody else that can benefit from it, that you know that might be an executive or a high income earner, or even a business owner looking to get some additional tax breaks in retirement. And if you like this video and you want to see more videos just like it, I release a new YouTube video every single week. All you have to do is click that subscribe button and hit the bell to turn on notifications, and you'll be notified when the next video comes out. Signing off for now. I will see you next week on YouTube.